One of the magical tools in our toolbox that the majority of people just aren't aware of is something called. This is kind of like the golden goose in a way in which nobody really talks about this product, but it's great if you're able to create cash flow on an asset. So if you're in a situation where you're just kind of hitting a wall and you want to either turn over a multifamily property and want to have good tenants and have good cash flow, this product is made for you. This product allows you to scale to an unlimited amount.
What is up, YouTube? Matt McKeever here, and we're back with Josh and Ehren from the Findlay Mortgage Team, and today we're going to be talking about the ABCs of the different types of lenders and when we can be using these lenders as we're scaling our portfolio. So A lenders, B lenders, C lenders, private lenders. I feel like a lot of real estate investors have heard these terms, but a lot less investors have actually dealt with the different spectrum of lenders, right? It seems like oftentimes, I'm guessing people come to you and they've only ever dealt with AAA financing.
That, of course, yeah. So we always have clients who come to us and say, either I'm stuck or I've hit a wall, or what options do you have available? And there are a handful of options to scale, really just depending on where you're at personally, where your portfolio is at, how you're operating, what type of asset you're looking to purchase next. So we wanted to break down all these different types of financing. If you go through our videos, you could probably find all this information, but we wanted to kind of compress it, give you a more up-to-date version of what's happening in the market right now and what options are available.
Yeah, I think this is probably a good video to start. Like Josh said, we've talked about this multiple times, and we've shown a lot of B lenders some love over the last year that we've been shooting videos, and we think that we brought a lot of light to them and how useful they are. But a good little synopsis, and I think the first place we're going to start, which is the obvious place, is with the AAA lenders. AAA lenders are a great place to start if you're looking to get into the rental game and building that portfolio. They bring some strength to the table in terms of, they have the most competitive rates. So when you take a look at how we qualify a mortgage, that rate is going to carry over into your next application, and that's going to help with your debt servicing. The lower the rate, the lower your mortgage payment, the better your debt servicing is going to be moving forward. So that's really the main strength of the A lenders is that rate. Now they have some other benefits as well too. On the uninsured side, they do have a 30-year amortization, which again, you're spreading out those mortgage payments over an additional 5 years instead of that 25-year am. So again, that helps minimize those monthly payments, which can help reduce your debt servicing over time as well. Another key part of the AAA lenders is they have some pretty flexible terms. So they have a 1 to 5 year term available depending on what you're looking for. You can get a fixed and a variable rate, which is great, especially if you're looking to complete some BRRRR projects. Having the flexibility to be able to get out on a 3 months interest is a pretty key part of keeping a lot of money back in your pocket. So just their rates and terms, again, on the AAA side are obviously the best that are going to be out there and the most competitive. Some of the A lenders do have a pretty decent rental underwriting policy. So Scotia, for example, does have a 50% offset, and they mitigate some of the secondary expenses, which you don't really see on a lot of the A lenders. Most of them just have that 50% add back, and we'll touch on that in a second. And then there's also a couple A lenders out there who use a rental worksheet, which is just another way of taking a look at almost just debt washing the property itself. So how much income is coming in, and then you just deduct out those expenses, and you're going to be left with some sort of like surplus or deficit number. And if it's a surplus, we can add that back in to help with your qualifying. If it's a liability, we just add that into your liability section. But even if it is a liability, maybe you're short $100 a month, having a $100 a month payment is much better than having to service your property tax, your heating, and your mortgage payment. So some really good ways to get in and start building that portfolio size, but there are some disadvantages and weaknesses to the A lenders as well too.
Completely agree. I think one more advantage is a lot of people use A lenders with insured products. So if you want to just enter the market, you only have 5% down, or you want to buy a multifamily that's decently leveraged, 5% for a duplex, 10% for a triplex and fourplex. It's a great way to be able to get into a multifamily property without having to put a ton of cash down. So the majority majority of our investors that we see come to us after they've already dealt with the A lenders. Now we do obviously help them with that, but most of the time this is how you start with the process. As Ehren said, there are some cons of using AAA financing. One of them being limited portfolio size. So depending on how much income you show on your T1 generals, that's going to dictate how many properties you can have. So obviously that's going to be a limiting factor. So if you're somebody who's maybe business for self, who has tax advantages and only shows, say, $50,000 on your T1, obviously that can be a limiting factor when it comes to using A lenders. Also, most lenders cap your portfolio size around four or five rentals. So it can be challenging being able to scale past that, especially if you're just buying single family homes. Personal debt servicing, as I said before, if you purchase properties with, say, a friend or somebody, or like a spouse, you're kind of limited to just how much income you can put on an application. The government isn't making it any easier at the moment, so the stress test has increased to 5.25%, which did cause barrier to enter the market a little bit higher than what it was about a few months ago. So, all things to consider, but the majority of people who are prudent investors or who have good finances or who are ready to get into the market do use this specific type of lender to get into the market.
Yeah, and a couple of other limitations too. I mean, the A lenders are limited to a 1 to 4 unit. Not, you can have some pretty good cash flowing 3 and 4 plexes out there, but in terms of the ability to cash flow on like a 6 and 8 and 10 type unit, you just limit yourself to the amount of units overall on the individual purchase. Vendor take back, so the ability to be creative with your financing on the A side. There are full AML procedures, full 90-day history, so borrowing private funds to get that down payment isn't going to be an option. Borrowing from an unsecured line of credit you can't do. There are some lenders that have gone back to allowing HELOC down payments. Sometimes it might be split 10% from your own funds, 10% from a HELOC, or some may allow the full 20%. But there are also some lenders out there who don't actually allow you to be gifted down payment funds as well too for down payments. So they're a little more strict on the down payment side when it comes to that in the creative financing. And one more limitation that we found, especially in the last few months, is a lot of the A lenders that we were working with that were allowing for holding companies to be the purchasing borrower are no longer allowing for those holdcos to be on title. It's come down to what we kind of gather just to be a risk perception from the lender standpoint, whereas if things happen to go self on the loan and default happens and they need to go power sale, they just kind of want to avoid that situation. It gets a little messy on the legal side, but a lot of them have pulled away from that, and we're really seeing the numbers of lenders dwindle down to maybe 1 or 2 lenders.
And then kind of in summary, when we're looking at these AAA lenders, I would say that for the majority of investors I see, their journey often starts here, right? So they take their paint by number deals, you can bring them to these A lenders and get it relatively easy financed, but oftentimes for a lot of us investors, at some point in time, we choose to kind of evolve beyond those paint by number deals. So whether it's our portfolio starting to max out or potentially we're taking on more unique deals, right? So another thing is, a lot of these AAA lenders, they want the property to be in living condition and kind of turnkey, right? Definitely.
Yeah, it's a very cookie cutter, fit in the box, square peg, square hole kind of thing. So if you have a property that has problems and you're looking to make some profit, it can be a challenge, especially if the property is in disrepair. If you don't have the rental income on the property to be able to help you support the debt, that can be an issue. Any house that past clients have purchased that are like hoarder houses, or need a lot of work to be done to it. So any flip or property that you need to put a bunch of money into, these banks, this isn't their bread and butter. This isn't what they like. They like MLS deals. They like cookie cutter deals, something that they can have a resale value if something were to happen.
Yeah, and speaking of rental income too, moving forward with those A lenders, most of them don't have a strong rental product. So, most of the time you're limited to some sort of 50% add back, which when you start to get to, that 4th property, maybe you're trying to get into your 5th, when you're only adding back 50% of that rental income, it's not quite as effective as some of the other products that we have, like on the B side and the small commercial, in terms of really maximizing that rental income. And when you're building that rental portfolio, that's really the whole purpose, is being able to utilize that rental income income. Obviously passive cash flow, but to help you move forward with building your portfolio. So a little limited with most of the lenders.
And it's interesting because it's really started to tighten up in the last maybe 12 months, because the valuations of these properties are just increasing, but rent hasn't increased. So, depending on where you're purchasing, say Chatham, for example, where you have high rent but low cost per unit, that 50% add back is great. If you have a whole portfolio of properties that are creating a ton of cash flow, that's super advantageous. You can scale with A lenders. But if you're buying a house in Brampton that isn't even cash flowing and you're just breaking even, or maybe you're taking a loss every single month, that isn't advantageous to help you scale your rentals.
Yeah, I think maybe the last weakness is the ability to refinance out from a BRRRR. Most of these A lenders are going to want you to be in that property for 6 months before they're really going to consider giving you that refinance, and especially if you're looking to take out a huge sum of equity. If you're looking at $200,000 in equity takeout and you're 2-3 months in, you're going to have a really tough time being able to convince the lender, even to just go ahead with the refinance, let alone give you that money. It all comes down to AML. They want to make sure that initial down payment has had time to digest, make sure it all looks good, but also they want to make sure that you're not just refinancing on market appreciation and then 6 months down the road that market takes a turn and now that value is gone. So one of the things we recommend is just taking pictures before and after, documenting all the budget and renovations that you do. The more documentation we have and the better story we can tell, the better the chance that we're going to have to possibly able to get that refinance done at 3 months instead of 6 months. And when you're coming from a private lender, that 3 months of 8% can be a pretty large difference in bottom line and cash flow.
Absolutely.
Yeah, so I think the next lender we want to talk about, which is our solution-based lender, is the B lenders, or the Schedule II banks. For those who haven't watched any of our previous videos, these are federally regulated lending institutions. They are Schedule II banks. So, they might have gotten a little bit of a bad rap in the past, or maybe just didn't have as much light shined on them, and from previous brokers or mortgage people. But we love the B lenders. They're some of our favorite partners to work with. They're really flexible. They offer a lot of great solutions for our clients. So, maybe in this case you're a business for self person and you're looking to get into that first rental property, but you write your income down to $30,000. Well, the A lender is only going to allow you to use what's on your T1, whereas a B lender, we can do a stated bank income. So we can take a look at your business bank statements for the past 6 to 12 months, see how much revenue is flowing through there. And if you got, $200,000 in revenue, maybe we can use 45 or 50% of that. And if we're qualifying you at $100,000 instead of that $30,000, well, now it's a completely different game in terms of qualification and your affordability, especially when you take into consideration that the B lenders also have increased debt ratios. So we're on the A side, we're qualifying with a 39 and a 44 GDS TDS. On the B lenders, we're around 48 or 50 sometimes, and I think even Home Trust will go up to 60%. So when you take a look at how much further that $100,000 of income goes when you have an extra 6% in debt that you can carry, it's a huge game changer. It's a pretty strong factor. B lenders are really great for maximizing rental income and using that to help with the affordability. They use what we call as an offset. So that offset literally offsets the cost of the expenses for the property, and if you have enough rental income outside that, you can actually add back as well too. So really strong properties will give you a bit of a twofold effect where you're mitigating your expenses that you're qualifying with, and you're adding income back, and you have higher debt ratios. So the B side is a super borrower. It's a super lender, I guess. Really strong solution-based type product. It can be a great step for those who maybe can't get into their first property on the A side, but just need help getting in, and then maybe that rental income might help them on the A side if you can take that to Scotia and get them in that way.
For sure. One of the great things about these types of lenders as well is there's no portfolio limit on the size of how many you can have. Now, some lenders might not still allow you to have 7 properties with them, but they're not going to be you have 6 properties, I'm not giving you another property. As long as you qualify and you hit the ratios, they're going to allow you to be able to scale and find that solution. Now, B lenders or solution-based lenders, they are a great solution for your situation, but when you get one thing, you have to factor in another. You can yin and yang, you can't have one without the other. So there are some cons about using B lenders that everybody should be made aware of before you decide to use them. One being, fees. So it's a kind of a pay-to-play situation. So the advantage of using a B lender is the solution, but maybe the disadvantage is going to be a little bit of a rate hike. So that rate is going to be a little bit higher depending on what lender you go with. That rate for owner-occupied is still very competitive. You're at the high 2s right now. For a rental, you're in about the mid 3s. If you're looking at like a home trust, for example, you might be almost in the 4s. So the solution to take a B lender versus maybe taking a private lender, it's no comparison. Taking that 3 or 4% rate is way better than taking a private loan. There is a broker fee and there's a lender fee involved. So unlike an A lender who compensates your broker, B lenders don't compensate them the same. So there is a fee at our end of 1%, and then the lender does charge a 1% fee as well. One of the other disadvantages is that the terms in these loans are usually just 1 year. At least the most competitive terms are 1 year. So having the certainty with an A lender of a 5-year fixed term or a variable term, knowing that you're not going to have to go deal with the bank or change your rates, that's something that's great, but if you're looking for a solution, it might not be what you're going to be dealing with at the time. So knowing that you might have to lock into a 1-year term, and then have to face whatever the market's going to give you next year. Usually what happens is when you're done your term, the bank will just give you renewal papers if you're in good standing with them. So you're not going to have to go through the whole process of re-qualifying for the loan or paying a broker fee and a lender fee again. As long as you want to stay with the bank, they'll just give you your renewal papers. Another, con was going to be the fixed rate. So most B lenders only offer a fixed rate. The variable terms aren't necessarily always available, and if they are, they're extremely expensive. There's a few players in the market who do offer variable terms, but they're not very advantageous when it comes to trying to get some cash flow in your property. So that fixed term is going to come with an IRD, which is an interest rate differential. So if you're looking to use this lender as a step in your BRRRR, understand that it could be very expensive to break your loan very early in your term. So the solution is there, but it also takes a little bit of flexibility away from you being able to restructure your debt, which can be decently challenging. These lenders also only offer conventional loans, so 1 to 4 units, so they don't move into the private side or the commercial side, sorry. They allow you to, they definitely become more advantageous when you have more cash flow. So as Ehren said before, if you have a bunch of cash flow on a property, then using 80% of that cash flow and offsetting the costs, if you have enough cash flow on a property, essentially washes the entire cost of debt servicing on the property away. So really great there. One of the disadvantages that you might find with a B lender is limited use of a holdco. So they will allow you to use it, but they're going to limit your ability to be able to use it. So one of the private lenders, or one of the B lenders, for example, wants each individual rental property to be in its own holding company. So they don't want to mix properties together, because if they were to have to go power sale or something were to happen, they want to make sure that that asset is individual and they could just focus on dealing with that situation at the time. So if you are looking to purchase a property in a holding corporation with a B lender, just know it's not always 100% certain that they're going to allow you to do that, especially if you have all of your additional properties in that holding corporation. And last but not least is the creative down payment solutions. They will allow you to borrow on a home equity line of credit or get gift from a family, but when it comes to vendor takebacks, they're still conventional lenders, so you can't use seller financing to fund any of your down payment for these types of lenders. They can be flexible and they can definitely help you get in, but vendor takebacks does fall under secondary financing, and federally the government isn't going to allow you to use that as a down payment source.
Yeah, I think one thing to touch on from the pros was they do allow you to borrow from your HELOC and your unsecured lines of credits, but you do have to be able to debt service that. So if you're borrowing off of your unsecured line of credit, just remember that that's a 3% payment per month that we have to use to qualify. So it's great that you can borrow it, but if you're looking to borrow $100,000, can you service that $3,000 a month loan? So pros and cons, the flexibility, but that debt servicing still has to be there. Really I find on the B side, as you add rental properties in your portfolio, your debt servicing actually almost gets stronger because of that rental offsetting. So it's usually not a problem, but there are some limitations to being able to borrow that down payment.
So One of the magical tools in our toolbox that the majority of people just aren't aware of is something called small commercial lending and commercial lending. So when we have clients who own a portfolio of assets and they want to scale, they come to us saying, how do I do this? This is kind of like the golden goose in a way in which nobody really talks about this product, but it's great if you're able to create cash flow on an asset. So the small commercial product allows us to underwrite conventional real estate, so a single family home, a duplex, a triplex, or a fourplex with commercial underwriting parameters. So we take a look at the total income on the file, and we also assess the total debt on the file, and we find a debt service coverage ratio on the asset. And as long as that asset is servicing and it's able to become a self-sustaining asset in the eyes of a bank, the bank is going to allow you to be able to leverage usually 75, sometimes 80% of the value of the asset, and they'll give you a loan, which is great because a lot of people who have maybe 6, 7, 8 properties, there's no way you're qualifying with a conventional bank, even if you show $150,000 on your T1 General. It's very difficult once you hit a certain point. So, you know, this product allows you to scale to an unlimited amount. You're allowed to use a holding company for these properties. They don't necessarily care if there's other assets in that holding company. So, you know, you can have a pre-existing holding company and purchase property in it. They do have flexible terms, usually a 1 to 10 year term. Almost all of the larger credit unions offer this product. They each have their own different underwriting parameters. If you go back to a few of our videos, we kind of break down how that works. They can offer variable and fixed terms. So if you're an investor and you are looking to be able to possibly restructure your debt down the road, this isn't something that's going to lock you in and you're going to have to pay a large fee on. So, you know, taking that variable term, you know, you're still looking at between prime plus 0.2, prime plus 0.3, so still under 3% on a commercial loan. Now, there's no personal debt servicing involved, and the cash flow is baked into the actual DSCR. So some lenders are going to require that we factor in property taxes, utilities, insurance, and then we factor in a property management and maintenance costs, usually around 5% of the gross annual revenue. But if you're able to purchase, say, a turnkey asset, and that's your strategy, you know, this is a great product. You know, we're seeing a lot of clients use this as a takeout financing for their BRRRRs. Yeah. So if you're able to go and find a multifamily property, and that property, you say, hey, Josh and Erin, it's going to be worth $700,000 when it's done. How much revenue does my property need to generate to be able to support that much debt? So we'll reverse engineer it backwards, say 75% is 700, and then we figure out how much revenue on each individual unit you need to generate, and then that's your target. So, you know, have higher end finishes, you know, create, like buy places that you think you can fetch $2,000 a unit for rent. And as soon as you can understand the minimum requirement of revenue on a property, you're able to scale to an unlimited amount, which is great. One of the other advantages is VTBs. So because it's a commercial product, lenders will allow you to factor in a VTB as long as the monthly payment can be serviced within the minimum debt servicing requirement. Now I don't want you guys calling us saying, hey, I got a 25% VTB, zero money down, it's going to be great. That's not how it works. So the bank still wants to see you have cash in the deal. So if you have like a 10% VTB and you come up with 15% or however that might look, they still assess you as almost a whole picture. So when Erin and I are speaking to clients and they're like, well, does this work and does that work? And it's very difficult to be able to say definitively yes and no, because it's more like painting a picture. It's like, you know, are you a strong borrower, your personal net worth, your cash flow, your portfolio? How does it all look in total? You know, and are you a strong person? And if the asset is strong and you're strong, then usually they're able to find a solution to help you, scale your portfolio. They want to do good business, especially in that golden horseshoe area. It's phenomenal business for them. Like cash flow multifamily properties with strong borrowers. Like it's what they're looking for. So if you're in a situation where you're just kind of hitting a wall and you want to either turn over a multifamily property and want to have good tenants and have good cash flow, this product is made for you. So reach out to us. We're always happy to use this product and help other clients.
Yeah, I think yeah, a lot of good pieces of information, a lot of pros. Like, there's so many pros about this small commercial side that we could talk about it forever. One of my favorites is they actually have a very designated student rental product where they allow you to rent it out by the door and create the lease by the door. So in the past, we've seen borrowers try to cram everybody onto, if it's a duplex, you got 2 leases, you got one person on the one lease, and maybe everybody's trying to pay in through that one guy, and it creates a lot of hassle. It's a gray area. It's not the easiest thing to try to submit into a bank. There's always the issue of, if they find out it's a student rental, what happens? But these guys, student rental, great. Like, just tell us ahead of time. It does require a little bit higher on the debt servicing, but they're okay. Rent it out by the door, which helps you to maximize that rental income as well too. So, they're okay to go student rentals 75% for the most part, which is a really great option when a lot of people we're big into the student rentals. I'm sure we're going to see a little bit push back into there once things start to normalize and open up again, and kids are going back to school, but I don't think the student rental market's going to go away by any means. So, a strong asset for those looking to either refi or rebuild their student rental portfolio. Like every lenders, there are some, weaknesses and disadvantages. The main one with the credit unions and small commercial is that it is a small commercial product, so they are underwriting at a 25-year amortization. But like Josh said, that cash flow is already baked into the debt servicing. So if they're giving you the loan, you're already making, 25 cents on every dollar it costs to maintain that 1.2, 1.25 debt servicing. So even though it's 25 years, you're making money, or they wouldn't give you the loan on the property, which is a strong benefit. They're not the strongest lender for some single family properties because they take a look at all of the expenses and they don't use your personal income. So you got a single family home that's renting out for maybe $2,000. That $2,000 is going to have to service the property tax, your insurance, the utilities if you pay it, a 5% property management fee, or maybe a 3% property management fee. Most lenders are still using a 5% vacancy fee, even though there are no vacancies out there right now. They're still looking at that. Maybe some maintenance and repairs. So those single source income type properties are a little weaker, but when you start getting into that duplex, triplex, fourplex, and above, it's a great product. One of the other kind of weaknesses is they don't really have like a true HELOC property or product. Because it's a small commercial and a business, they have operating lines available, but it's a little bit more limited to business-esque type things where they want to see cash flow on that line revolving in and out. So not true standard HELOCs like you're going to find with the A banks. So a little bit of a limitation on that sense. Keeping on like that small business talk, it's looking at the business being generated as business revenue. So they want leases in place, or a signed lease that's going to take place within a reasonable amount of time. So if you're going to pick up a property and maybe you just have to do some light touch-ups, you just want to redo the floors quicker, do some painting, and you really need about like a month or two, we do have some ability to work with that. So maybe you get a lease in place, post-date that lease to take effect after you're going to have your renovations done, and we can take that to the credit union, tell them the story, say, hey, look, they're just sprucing up the unit, we have leases signed, ready to go. They can make some exceptions and allow it to get done based off the debt servicing of those leases that are going to take place after the renovations are done. So this isn't a, hey, I got to gut my house and do a complete 1-year renovation, but if you're just doing some light touch-ups, we can work with that if you have leases signed and ready to go and in place. Turnaround times tend to be a little bit longer on the small commercial side because it is a commercial loan. It does have to go through like a full credit analysis, and they underwrite a little bit backwards, where they'll issue a proposal or an LOI first, a letter of intent, outlining their specific terms based off the initial details that they've seen. If the client's good to go with that, we'll go ahead, order the appraisal, and then after the appraisal is ordered, they'll submit in all the documents with the appraisal to their credit team, give it maybe like 3 to 5 days to turn around, and then after that, they'll issue loan documents. There's going to be account documents too. That adds a little bit of extra time in getting that set up, because with the credit unions, you do open an account with them as well. So there is a few extra steps involved. So on that small commercial side, you're probably looking at 5, maybe 6 weeks, depending on the size of the purchase. But if it's a 1 to 4 unit, you're maybe a little bit closer to that 4 to 5 week turnaround time. Really depends on how long it takes to get the appraisal done, really.
Yeah, I think one of the really important aspects of this specific product is understanding the requirements yearly. So they qualify based off of the net operating income. So how much revenue are you generating? Well, because they're a private bank and they have, you're all shareholders in this bank and we're all responsible to you as the shareholders, we need to make sure that our loans are operating at a minimum level. So every single year you are required in their commitments to be able to show them notice to read your financial statements of your property. How much revenue is it generating? What are the expenses? Making sure everything is in line to ensure that their loans are still in good standing. So if you are going to be using this product, ensure you have to have your taxes done on time. You have to have your corporate taxes done on time. You have to be able to prove that you're running a tight ship. So if you're somebody who's really disorganized or who doesn't get their taxes done, this probably isn't the best for you, because there are some financial ramifications that could come of you not being able to provide certain documents to the lender every single year. Phenomenal product, but I think most of the time a lot of our clients do have it together, so it's not really a problem being able to show those documents. But making sure that you are recording everything and keeping track of everything. It's very easy to be able to keep track when you're in a corporation, but if you're just purchasing in your personal name and you've got a bunch of receipts everywhere, you're going to have to show that at some point. So understanding that there are going to be some residual things you're going to have to deal with the bank on an annual basis if you are going to use this product. Last but not least, there are some fees involved. So for commercial lending, the banks don't compensate brokers for commercial lending. We bring them good business, and they're very happy about us bringing good business. They're willing to work with us, but unlike a conventional bank who pays us to bring them good business, they don't pay us. So it's usually about 1% of the loan amount is what we charge. And the bank is going to charge a nominal application fee to set up. So possibly, 0.25% to 0.5% of the application fee, depending on what that looks like. So just something to keep in mind, there is a cost to being able to scale, especially, this product is created to allow you to take on great cash flow on an asset. So when you're looking at your bottom line, it's just an expense to be able to have a well-performing property.
Awesome, guys. Well, as you can see, there's a lot of solutions available when it comes to looking at scaling your real estate portfolio. And I think as Josh and Ehren laid out for us consistently as we went through the ABCs here, it really does come down to your situation and the context around it, right? And that's why you need someone on your power team that actually understands what's going on in your business. The same way that your lawyer, your accountant needs to understand exactly what's going on in your business, so does your mortgage expert, right? So that's why we're bringing these guys on to break down for you exactly how you can set yourself up for success if you've got the right power team members on your team. So link in the video description down below to Josh and Ehren's contact information. Really encourage you guys to reach out to them or someone else on the Findlay Mortgage Team. But until next time, I guess any last words of wisdom as we're looking to scale our portfolio?
There's no limit of deals. So, as we move out of the recession and, COVID goes away and the economy is going to start to boom again, I think we're going to see a huge influx in people looking to purchase property still. There's great deals out there. Finding a solution in this new market to be able to capitalize on those deals are super important. As you said, everybody's situation is different. So just realizing what products are out there, be informed, and speak to an expert when you're looking to make a decision.
Awesome. Thanks, guys.